Okay, so in addition to the income statement, the balance sheet, and the cash flow statements, there are some reports that need to be included in the overall annual report. And uh, and here are the three: management discussion analysis, notes to financial statement, and the auditor's report. And these are written in combination with the accountants, the auditors of the company, the management of the company, and the board of directors. Let's take these kind of in step. So the management's discussion needs to cover these three items: liquidity, capital resources, and result of operation. Liquidity meaning, does the company have cash? Capital resources, does it have enough long-term resources to do its business? And the results related to the profit or loss. So here's an example of Tootsie Roll, a candy company. The company continues to maintain a conservative financial posture. Aside from an immaterial amount of operating leases, the company has no off-balance sheet finance arrangements, and our simple financial structure does not utilize any special purpose entities or other obscuring financial arrangements. So this company is conservative and wants to make sure everyone knows that it's by the book and it's not doing anything special or tricky. If the company is doing something special or tricky, this is where it has to disclose it. Okay, and in many cases, it's the bigger no is to do off the sheet techniques and other sorts of financial schemes and not say it. If you do it and it's legal, but it's just creative, that's fine. But you just need to disclose it. And this is where you would disclose it. The second set of reports are called notes to financial statements. And these notes do a couple of things. One is it explains anything special, and sometimes you may have some special statements that you have to include, and this is just going over what those statements are. It clarifies any information in the financial statements that there's sometimes things aren't clear. Gives additional detail, describes accounting policy, and explains any uncertainties or contingencies, lawsuits that may be coming up, or changes in the environment that may have an impact, a material impact on the company, and that sort of thing. So here's one. Revenues are recognized when the products are shipped and delivered to customers, which is, of course, the standard, but you'd expect that because Tootsie Roll is doing it. But this idea of revenue recognition is a big one. Groupon had a big issue on when do they recognize revenue. When do you recognize revenue? If you sell something on a over time, let's say, do you recognize the revenue all up front, or do you recognize revenue over time? Depending on the industry, there are kind of standard practices which you need to say. And if you're doing something a little bit differently, you need to say that as well. The auditor's report. These reports are handled by certified public accountants in the U.S. or certified accountants in whatever country you are, like Sweden, for example. And these, because the financial statements are made by the company, so an outside third-party independent examiner of the statements has to give a report. And what you want is them to say that the financial statements fairly represent the financial status of the particular company and that they have followed generally accepted accounting principles. And you want an unqualified opinion, meaning that they don't say, we like these finances, but. Okay, we like these finances, but. Now, this is a little interesting, sensitive, and tricky, is that, of course, the auditors have to be paid and selected. So it's the board of directors that actually picks the auditors and pays them. So while the auditors are independent, they're not totally independent. But at the same time, they have their reputation to withhold. So that for the most part, ensures that the examination will be relatively independent. Because if they, and this has been done in the past, if they shade their report because the board asks them to, and it comes out, they may never work again, and that would be the end of their auditing business. So let's read this here. The board of directors and shareholders of Tootsie Roll Industry. In our opinion, the accompanying consolidated statements of financial position and the related consolidated statements of earnings, comprehensive earnings, and retained earnings, and of the cash flows present fairly in all material aspects the financial position of Tootsie Roll Industries, Inc. and its subsidiaries as of December 31st, 2002 and 2001, and the results of their operation and cash flow for each of the 3 years in the period ending December 31st, 2002, in conformity with the accounting principles generally accepted in the United States of America. So this is like the best statement that you can have. Why? Because auditors did it. They looked at all the statements. They said it was fairly representing. They said they followed general accounting principles, and they had no qualifications. So this is the kind of statement that you want. Crystal clean. So just to end up here, we talked about what assets were, what liabilities were, what stockholders' equity is, and we talked about the basic statement. We talked about the basic accounting statement. Assets equal liabilities plus shareholders' equity. We identified who uses accounting information. There were internal managers and external agencies and people interested in that information. We talked about the 3 principal activities of business. Remember? And then we described the components that supplement the financial statements in the annual report. So this gives you a quick and dirty on financial statements. When we look at financial statements in an annual report, you'll have an idea of what they are. And this will lead to a good understanding of actually some of the things that you need to report in your business plan as well. Okay, see you next time.